Welcome to my channel again. Today I'm going to talk about the 3 no-nos of doing a 1031 tax deferred exchange. As you may know already, a 1031 exchange or a 1031 deferred exchange is a way of saving on your taxes when you sell a rental property or investment property or commercial property. By the way, I'm not a CPA or an attorney, so if you have any specific questions or you need a transaction, feel free to contact them. I'm just giving you basic information about 1031 exchange. I am a realtor and I do sell or have been involved many times in doing an exchange, representing the buyer, representing the seller, and or representing both the buyer and the seller on the same side. So I've noticed that there are 3 no-nos in which we get asked all the time. The number 1 no-no on doing a 1031 exchange is that if you're living in a property and that's your primary residence, you cannot do a 1031 exchange on that primary residence. It only applies to investment properties. Now, if you are in a primary residence and let's say you moved out of the area and you bought another property and then you rent out your primary residence. So after a few years, and I won't get specific in it, like I said, I'm going to give you general information. After a certain amount of years, you can sell that and do a 1031 exchange where you can save on capital gains taxes. So that is okay, but selling your primary residence and doing a 1031 is not allowed. The second no-no on a 1031 exchange is that you have a time limit. As soon as you close your escrow on your down lake property or on your property, to buy the other property, you have exactly 180 days. And within that 180 days, you have 45 days to identify up to 3 properties, and you must purchase one of those 3 properties. So it's very critical that when you close the escrow or before you close escrow on your current investment property or rental property, you know what you're going to buy, where you're going to buy, you're qualified for it. Because the time starts ticking, you have 45 days to identify those properties in writing, and you have to close on those 3 properties. If you don't close on those properties, there may be consequences where you may end up paying taxes. And for specifics, please contact your accountant. The third question that we asked all the time, or that's a no-no in a 1031 exchange, is that, and I'll explain this point by an example. So let's say you had a property and you bought years and years ago for $500,000, and now after 5 years, 10 years, 15 years, whatever amount of years it is, after additions and renovations, it's worth $1 million. So you have a capital gains of, let's say, approximately $500,000. It's not exact. There's expenses you can add to your basis and all that, but for this purposes, let's say your gain is $500,000, and let's say to do an exchange you have to buy something for $1 million or more, but let's say for some reason you want to pull some money out for whatever reason, for your kids' education or for remodel or to buy a bigger residential house. So you are allowed to pull some cash out. But if you pull that money out and let's say you just invest $900,000 and you pulled out $100,000, you will be taxed on that amount that you pulled out, which we call boot. So be aware that if you pull any money out, that is subject to current taxes, capital gains taxes. So this is basic information. If you wanted to know more about the 1031 exchange, I have another video. The link is right here. Feel free to click on it. And if you have any specific questions, of course, call your attorney or your accountant, but feel free to leave comments below. I'll be glad to answer any questions for you or give you specific resources or even connect you to attorneys that I know and accountants that I know that specialize in 1031 exchange, whether it's local, I'm in Orange County, I'm in Anaheim Hills, or if it's out of state. By the way, my name is Patel. Thanks for watching, and I hope you subscribed.